This conference will now be recorded.
Hello, everyone, and welcome to Coronavirus in Your Retirement. My name is Jeff Serino, and I'm the founder of Alpha Planning. Founded it that way back in 1993 when I was a very, very young man. And so thank you for joining us. But did you know that when I was as young as 6 or 7 years old, I hated money and was afraid of it. It may sound funny coming from a career certified financial planner, but it didn't start out that way. In our family, the mere mention of anything to buy or money or upcoming or something that would be desirable would cause a lot of stress. And it always had a negative connotation. And I could even hear my folks talking about it next in the bedroom next to me. I could hear it through the walls sometimes, the heated arguments that would come up about obligations or disagreements about where whatever resources they do have, where should it go? I love my folks, of course, and the thing is, they would have even had admitted that they weren't the best with money, and so they kind of were a bit financially illiterate. And I'm the youngest of four boys, and we ranged 16 years apart. I'm the youngest, and the life changed again when I was 10. We ended up moving abruptly and had a whole new experience in front of me. And my other brothers that were the younger ones were still in school were also very, very much affected by things. And these money issues plagued my parents for many, many years, actually through their whole lifetime in a way. They were a little bit in want all the time. And, there's only so much you can do for someone else. Yet, this is kind of a quick tale of four brothers, really, two pairs. Two of us brothers broke the cycle of financial illiteracy, and we learned through our life experiences in school and whatnot. My brother and I are both very different, but we both learned outside. We broke that cycle. We rewrote our program. So that educational process is really important because I can help people with this. I've been helping people with this in my career. But two of our other brothers were not so lucky. We have longevity in our family, but two of our brothers were lost, one to alcoholism and one to veritable suicide. Why would I share that with you? Well, because if you look back, yes, they had other issues, of course, but it's not usually just one thing, but it was really just a compound effect in the negative sense of lifelong ways of never really learning to become financially literate or going into new territory that were new for them. And I doubt that anyone watching this video right now is financially illiterate, but it's the process of knowing a lot more of the subtleties and complexities in retirement. So one day, my whole thing just came to me to round this story out, and I can get to the body of the program. Is when I was still pretty young, I was watching once the Where Are They Now series about people who won lottery winnings and what happened to them. And there was one particular person, Evelyn Adams, who really had a job, had her own house, had a small 401k before winning not only one, but two New Jersey Super Lottos. And the Where Are They Now result was within 2 years of her last winnings, she was now living in a double wide trailer on public assistance. She didn't have a 401k, she didn't have anything. Well, this is when it really, really hit me that money has never been the problem per se. It was my parents that were the problem. It was my couple brothers that had a problem with it. There was lots of people, very successful people that have problems with saving or handling or really wanting to get into the details of this. So this is where my passion comes from, because I see the damage that it does on all kinds of levels by not having the right kind of financial help. But we're talking specifically about help that we specialize in for people over 50 that are 5 to 7 years from retirement or already in retirement. So I'm going to go over today and share some of this passion with all of you. And I just want to tell you another quick thing, that I feel that our industry very much underserves people. And I have always Perhaps it's just my own thing, but I always felt that things needed to be different. And what's different is that we combine tax advising with asset management and retirement planning, number one. Okay, and number two, we put process first before product or portfolios. The industry is completely the opposite. Typically, they might do a little cursory upfront stuff, usually sometimes nothing, but they will still accept assets and do that. And that's sort of the easier part of financial planning. The more challenging part I always going to drag you to is this: the complexities of taking money out in retirement from multiple sources, as you'll see, has a big effect on your money. So I'm going to get back over and we're going to switch to the slides and me off, and I'm going to share this with everybody. So just to run over a couple of things, because I don't have the benefit of having an introduction from someone else, but I'm not going to talk about myself other than just mention a couple of blips here outside of that. And is that we are a fiduciary firm, have been for probably well over 15 years. And we're held to a higher standard. And that's what that means, that we have to prove that what we're showing people on an ongoing basis is going to be what's best for them and not necessarily better for the pocketbook. Because the public doesn't understand how all advisors, so many are structured so differently, but they all may look the same at first glance. So I also want to point out the enrolled agent next to the certified, two credentials away from the certified financial planner, that it's an enrolled agent. And I mentioned a moment ago that we combine tax advising with everything else that you normally would get with a comprehensive fiduciary that does an official plan. So we'll show you the benefits of that. So thank you for indulging me on this. I also have 5 books, but these are the most recent 3. They're available. We give them away when people come in. I'm even going to make an offer to send you the Retirement 2020. If you do come up for a virtual appointment or a one-on-one appointment, which we are able to do now, we're going to send you that book out at no charge, so that you can read it before you come in or before you have your virtual visit with us. So let me get into the meat and why you tuned in to see this. There surely has been no shortage of fear stuff that's reality-based and fear things that are just opinion-based. And that's always been the problem. Anytime something big happens that causes some sort of panic. But it's not just how coronavirus will affect your retirement that we're talking about today. It's how much will the next thing that comes, when will it happen? Will it be something like this, or will it be something else we never thought would happen? So that's the point, is that in retirement, we have less time to keep waiting for all of our portfolio to come back. We're not espousing going away from the market, but we're going to show you a carve-out strategy that takes literally 80 to 90% of the market stress out of your life, as long as you're retired and as long as you have a team helping you stay on track. Yeah, of course, there was all the big news articles, the Dow falling, et cetera, most in one day. The market went down about 33% roughly, the S&P, and it is still only 14 points away from the high, the last high of this year. So that's pretty resilient, and we think it's going to bounce back. But it's the speculation of this kind of stuff is where, when you have your whole nest egg resting on it, it magnifies it, and it can often make you less happy. And that's what it's all really about. So here's some I always call it some fresh meat for viewers here, because you've been wonderfully patient thus far. But here's some of the most recent COVID-related changes that have gone into place that the public is barely aware of at all. We've been notifying clients of this and people that are thinking of being clients, that there are no RMDs in 2020. Now, if you're under 72 right now, You may not even know what an RMD is, and you don't need to worry about it now, but I can tell you that it's going to be something that you'll have to start taking, and you become quite familiar with it as part of the retirement planning process. And that's where our tax planning comes into play as well, coinciding advice. So, no required minimums, even if you're over 72 or for anyone, and there are also no RMDs for beneficiary IRAs. That means a non-spouse, like if you inherited one from your mother, father, brother, just a non-spouse transfer of an IRA, you do not have to take any withdrawals. Now, if you need the money, you just go ahead and continue on. It's just that there is no minimum threshold to meet this year. So we like to keep people ahead of the news. We've got all the Secure Act stuff that changed from January 1st, got all that baked into things here. So we'll keep on moving. There's also going to be no 10% on a pre-59.5 penalty just for this year only. Will it be for another year? Will it not be here again? It's not something you would use for long-term planning, but you would only do this if you really need to keep your house or to make your way with things, at least temporarily. I don't recommend, there's ways you can pull money out systematically with no penalty under the age of 59.5, but this is a one single year thing, and you can only, it's just something you might take advantage of now if you just need to take money out. But hopefully you don't. And so that's something we'll talk about, how to make sure that you always have plenty. Moving on, they've increased loan limits in 401ks from 50,000 to 100,000 across the board. So that's an ERISA related change as well. And there is a fourth one. Filing date has been moved to July 15th from April. And this also means that if you make contributions for IRAs or things like that for the prior calendar year that you would do by or before April 15th, you actually can do them on or before July 15th this year only. Okay, so those are this is fresh off the presses. This is still warm, very much so. But these are the things that could potentially affect. I would say that the first one is pretty impactful for people who are forcibly having to take RMDs and they don't live on the income, or they don't in a particular year. That's good. But if they need the money, they're still just going to keep taking it. And that's the bottom line. So if you need it, you need it. Look at the three biggest mistakes I and my team have seen over the decades. And the three biggest mistakes retirees make is that at 50 to 55, they don't start to ratchet down and carve out some of what they really could use for income, because they think that either I stay young if I stay in portfolios, but they'll actually can age you sometimes, times like this especially. But it's really just a way that you can still be having a split strategy. You are able to still be a long-term investor like you always have been, but you don't have your entire income future riding on it. That's a big point. Second is not having a precise, not even having an income plan. All of our clients have an income plan in some form or another, that even whether they need to refer to it a lot, most of them do, but it's a way of just keeping track of what your expected taxes are going to be, where your income is going to come from. Also, we have to integrate rules like minimum withdrawals. If you have, those have to be satisfied. So there's all those kinds of rules that are very complex and not easily accessible or integration friendly to a lay person who's just trying to do some reading of their own on it. It's a very deep subject. So not having a precise, but 2 and 3 are really the same thing, because you can't have proper tax planning without having all of your income and asset sources quantified, evaluated, and shown how and when or if they should be utilized. And then what would the tax planning, what would the tax consequences be? That is huge. I'll show you at the end of this presentation what I call tax collateral damage. You may find it very, very interesting. But not having a plan, first of all, is like flying without indicators, without any kind of dials, lights, anything at all. And I think it's really a reckless thing to do because of the volatility of things in the world, not just the markets, and because of the cost of everything, healthcare, and all those important things that we touch on in our full process. But not utilizing tax planning is something that almost no one, unless they meet a special firm that does that, such as us, because they don't have a plan. You can't really do an ongoing tax plan. You can look ahead for the year, but that's not really where the true tax planning comes into play. So that you understand, John Q. Public, that the average person in the business is a broker who is an asset collector. Now, they can do some, and sometimes even very detailed plans, but a lot of times their whole thing is just to collect and to think in terms of purely of growth. They're actually forbidden by the parent companies to give any specific tax advice. So then you have to separate professionals and go to a tax professional and then get them together and to see if they agree. And it becomes a very cumbersome thing, especially ongoing, going through 20 to 30 years of retirement. So that's why I found it. I said, we're going to get that expertise. And we did that about 10 years ago, that we're adding this official. So we could speak with full tax authority as an enrolled agent. We are trained and educated by the IRS, and we have a continuing education and monitoring and all that good stuff, just like the CFP and all the other credentials there. So 2 and 3 are really the same thing. You at least have to have 2, but if you see how easy it is to plug in 3 once you have a plan, we have a plan that's comprehensive that does have all of those things in one place. That's the key, one place, and it's updated every year. It's a living thing. It's something where you have options each year where you could pull money from or so. But let's look at, like, say, how quickly your income could evaporate in the market. Look at the S&P, and this was at the height of the panic on Monday, March 9th, 2020. If you had this dollar amount invested, you would have that much remaining in one day. So what if that part of that, almost 38,000, whatever it's going to be, is going to be your supplemental income for 2 or 3 years? That's a mental blow, but yet you still need to take the money out too. So that's a financial blow then too, because you're taking money out of something when it's down. You're doing what's called reverse dollar cost averaging. And that, folks, you may want to write down reverse dollar cost averaging. And that is the cardinal sin to avoid at nearly any cost, because it can literally take years off your lifetime of your money, really. And I'll show you how that can work against you momentarily. So that 38,000 disappeared. That could be a year of income or 2 years of supplemental income for, alongside your Social Security and things like that. You have to think in those terms that it may pop back fast. Part of it has, but it doesn't mean that you would if you needed the money though while it was down. That money is lost. It's a lost opportunity. That's why reverse dollar cost averaging is the cardinal sin of retirement planning. Let's talk about a quick myth. They used to call it a rule, but 4% rule is sort of simplified and kind of a one-dimensional thought. And it's kind of way people often naturally kind of think intuitively, but it's not really the way things work because of all these complications many we're going through today. But the 4% rule was, hey, if I have X dollars and I only take 4% off of it, and that's my income, okay, in some years it'll do better. Maybe I could take more, or maybe that'll be there for the years that it might be down. But here's the thing, folks, that is just a complete theory and a total myth, because they ruled it down to, they dumbed it down to 2.5% rule. Wall Street did back in 2008. Now it's back to the 4%, and you can't keep moving the goalpost on important things. So that's what's happening. So if you had this 500,000 invested again, you were taking 4%, 20,000 out in income per year, hoping you could always keep your principal intact. But you know market accounts are not going to always stay at least at your water level or higher. They're going to have periods of dividends. It could be long, or it could be short, or it could be anything in between. That's too many questions when it comes to I need a specified income for sure. And in good years, we could take some extra money out from the market side. And that's what we do. We help people decide that also from a tax standpoint on your annual review. So that's that 38,000. You would have lost how much? You would have almost lost 2 years of income from that. And now that capital that was in there that you needed to take out is now gone. So nothing, something that doesn't exist can't bounce back. It's already been taken out and used. That's reverse dollar cost averaging once again. It's the one cardinal sin you want to always avoid. 9 hours, just think. 9 hours. So what do you do about all this? Well, I'm going to give you some solutions, some general ones, because we can't make these videos too long. I don't know really what's quite the right time for this. It's all kind of new for everybody, I think. But we're going to look at something called the sequence of returns, a very, very critical point, like reverse dollar cost averaging, because it ties right into this. Okay, and we have 2 guys, and they've done really nothing wrong. It's just a question in their lifetime when they decided or had to retire. And it's just going to show you that having all of your money in the market, it can go many different ways. But here's the 2 extremes. And you can plug this in with any decade comparisons that you want to make. But they retire with the same amount. They're keeping everything that has to the same for both of them. They take out the same amount of money. Plus, they're also invested exactly the same way. So there's no difference except when they retire. So you see on the left, we have Steve, and on the right, we have Bill. And the withdrawals are the same for both, and the beginning account balance is the same for both. But the decade treated each of them very, very differently. You can see that even after pulling out 300 grand on the left from Steve all those years, he still had growth on top of that. 1.2 is way more than he even started. But look at those returns. That was the mutual fund heyday, the 90s, when I cut my teeth in the business, actually. And then we have Bill on the right side, who did nothing else but turned a certain age, or he got laid off, or he just decided to retire, or he had a health problem. I mean, whatever it is. But look at what he did. Now you see that that's panic city, because 156,000, he's still a relatively young person. He's probably married. What's he going to do? He's going to run out of money. This has been reverse dollar cost averaging. He's been taking money out even in the negative years. Whereas part of our hybrid approach is that you take money, if you want or need to, from only in good years, because you have your income sources carved out that are there. And I'm going to show you that coming up next. So this is how you prevent all of your portfolio from being subject to this. Okay. I have to move on. And there's just the summary of what we just looked at. I mean, I guess just to impress upon you, you can see. I mean, that's on the left, the guy has options and can still fulfill dreams that involve needing to have to spend money to get somewhere or to do something. He can do it. The other guy is going to be thinking about working or something in that case. Now it could be in between, of course, folks. But these are really just a couple of decades that we've lived through. So it's not some far-fetched notion, hardly. Just look at the sequence of returns. It's going to depend. So when you just kind of stay the same way in retirement 4 or 5 years before, where you've not adjusted your risk down, because you don't need to. If you've saved enough, you don't need to have to make a killing every year and stick your neck out risk-wise to succeed. And what's succeeding? It means that you and your spouse never need money until you have your last breath. And if things are even better than that, you can make sure you can leave something so that people can remember you by. But that's really That's success, is not running out of money. And that's what this is all about. Let's hit some of the retirement facts of life. Stock market is definitely a growth engine. I mean, just look at the last 10 years. Until this Corona thing, it was just, gangbusters. For a decade, we didn't have one negative year. But now that's changed, and now that throws the calculus off for people who are ill prepared. Okay, so that's stock markets for growth. That's where you still go for growth. That doesn't change. It's just how much of what you have in your whole available nest egg. Is it all in the growth engine, or is some of it marked for special purposes? So I would say it can be an income engine, but it's not one that I'd want to rely on permanently under all circumstances, because there would come a point where we could end up with 156,000, and we don't want that. And that can happen when you're pretty old too. You don't really have your wherewithal like you did before to figure out what to do. You just have to realize, folks, the third fact of life is that retirement is different. And if you're approaching, like I say, maybe 5 to 7 years before retirement, you need to have a plan that will be able to work, be successful all the way through. And the plan doesn't mean restrictions. I'm going to explain this to some people. When you hear budget or plan, you think it's a restriction. But in actuality, the people that have plans are freer than people who try to keep all the stuff in their head, and a lot of it not based necessarily on fact. And as you get older and older, and things, sickness and dying happen, and that in time too, and things change, like this Corona thing is going to be something else down the road. You got to realize that retirement is different. So I would say, as a caveman, growth opportunity, stock market, yes. Retirement income, I would not say no, because in fact, over those, say, 10 years, we've been having clients take additional money or equivalent money from their safe source when the market's been up. That's how you take a little money off the top. And you don't always have to just ride everything all the way up and then all the way down. It's not like that anymore. You don't have 40, 50 years of blue sky in front of you. So what's a mother to do? So potential solution is this, and I'm just going to come right out and give you the solutions without talking about products. But the potential solution is, this is what we do. First of all, you have to decide. Your pie could be broken up like this. You could say, after a long risk discussion with your spouse and with our team, that's one of the first things we do with you, is to figure out how much are you comfortable with still keeping in the growth portion, and how much do you think would you like? And that's really, it's partially scientific, but it's also partially not scientific, because it's involving people's feelings. But that's the great thing when we can get a balance between what we think they should look to do, and they get time to think about it, and they say, I kind of feel okay with 50-50, or the other way, the other 60-40, 40-60, or some other mix. Okay, but to have only one color, whatever it is, whether it's all the safe, income growth, or that, would be wrong. You really should have both qualities, and you can determine how much you want to at least start retirement with. You can always increase your safe side as time goes on as well. Everything does not have to be all or nothing, and that's the whole point of this. I have a chart. I apologize if it's a little hard to read, but we'll look. Oh, let me go back, please. Sorry. So the potential solution is, we'll say a couple had agreed that they think 400,000 is enough to keep in the market. They don't like having their neck stuck out on everything, on all of their dollars. They decided that they wanted 600,000 to be safe, but also that 600,000 is going to produce the majority of supplemental income on top of your Social Security, if you have a pension, and whatever else there is. Okay, so in our particular case, we use, for the safe side, the most efficient tool that is known to man for the safe side, and that is a fixed indexed annuity. I have a whole chapter on several books of mine, the most recent one too, called, I've heard bad things about annuities, and I don't want to get into the publicity stuff that people bang around to try to move people, but there is no such thing as everything's all bad. okay? Because our clients have not lost 1 cent in any of these down markets that have happened in the last 25 years. Because I've been doing this hybrid strategy in some form or another with people my whole career. And it has made the people that don't even sweat things like what happened with Corona, the people that have a two-colored pie, whether it's 50-50 or whatever, but they realize that if I lose, I'm not going to lose as much as I would have. And so you take the majority of your money from the income focused side, the green in this case, and in really good years when the 400,000 is 425, maybe you want to pull an extra money out or keep a little more in the annuity that year and just take it out. You have these options and you get to talk about them in real time before they're done. And you know what the tax consequences are or what they will be. Does that sound good? To actually have clarity for a change instead of more confusion when working with financial advisors. So I've made a spreadsheet kind of just to show this 50-50, say half in annuity, fixed indexed annuity only. Now the fixed, real quick commercial on them, or I don't want to do this, but they have zero cost, they have zero market risk. You can participate with some contracts in 40, sometimes 50% of what the market does, but it never realizes any negatives in the down years. So you have your portfolio side, an example of a 10 and 20% down market, and you could see how much you would be down. But on the annuity side, you would be down 0. Now, because those markets are down in the next coming years or so, those indexed annuities going to get some nice return potentially, because each year they reset. They don't have to wait till this digs itself out of a hole for it to start to see a positive territory. And they lock in those gains every 12 months. So if you look at it all the way to the far right with the split strategy in the top pair here, the market down 10%, you're only down 950, whereas you would be down to 900,000. And then down 20%, you would be down to 800,000. That's a big psychological win or a big loss if you aren't. So let's look at the up markets. Okay, so you know you're going to be safe in the down markets. That's awesome. Even if that was the only thing, I think that would be strong enough to be still the highest, best candidate for the safe money. However, let's see how it works in up markets. Because well, it's logical to think, am I going to be losing now because I'm being too safe? Well, you have your market portfolios. Look at the up market in the middle here. Up market in the middle, up 10 and up 20. It shows you in your $1 million portfolio what the dollars would be. But in the middle, you see, because it's a positive year, you got part of the gains that you also got on the market side from your fixed indexed annuity, but now those gains are now locked in. The portfolio gains are never locked in unless you take some money off the top in a good year. That's the closest thing you could ever get to that. Okay, so you look at this, you have a portfolio in an up market of 10 or so, compared to if you were just in the market alone. The difference you can see for yourself. It is a very minimal difference, but you have to also figure in that you get locked in gains and there are no expenses to consider in the fixed index, because that's now the bond portfolio proxy that used to be for wealthy people. Rather than owning thousands of bonds, which is very inefficient these days, the indexed annuity works as the best proxy. We have an Ibbotson report that shows by having a split strategy, you do better than having all in one of the two. Because the annuity, you wouldn't make enough by itself necessarily, and the market, you have no safety net whatsoever. When you can combine those two, it's a very, very powerful thing to do. I've seen it firsthand hundreds of times. So we all want to be told we're just fine, but it's really most important that you understand, at least on a fundamental level, how things work. And that's why we do a multiple appointment process if you decide to come back in after your free consult. Very quickly, I just want to touch on a couple of tax things while we finish up here. These are the old rules. Right now we have on the right side the current tax brackets. And those are all the pre-2018 tax brackets on the left. They took away the personal exemption at the bottom, but they increased the standard deduction, and they've also taken away a lot of other things. But the brackets are the lowest that any of us have ever seen in our lifetimes, even our grandparents' lifetimes. Okay, and that's for singles. And the next one is for jointly, and you just kind of see the difference. But right now is the point I want to make about this, though, is that these rates, as nice as they are, they help you in retirement quite a bit. However, I've been warning people for this for the last 2 years that in 2026, those old rules are going to go right back into place. So in other words, what you see on the right will disappear, and it'll transform magically on January 1st, 2026 into the old rules. And there's nothing that can really stop it unless Congress gets together and changes it somehow. But it is set to go back without Congress doing anything. So what do you think the chances of that? Think about that for a sec. So I'm going to finish up here with a case study on taxation and retirement to show you how you cannot eyeball your taxes in retirement. And when you can find help for this kind of thing, it's just insane to not try to at least find, if you're comfortable working with somebody that could help you with this, because this is big. This is just as important as investment losses and everything else that we take into consideration. But I had a client, and he came in, him and his wife were over 72 at the time, and he had come from another advisor. He did his taxes. He was an engineer. He kind of calculated exactly what his taxes would be for the year by December 1st. But after 2 weeks later, him and his wife decided to pull out another $1,000. So he thought, okay, I'm in the 12% bracket. I'll just have to pay $120, and then the rest we keep. So here's his money, the fact pattern. 60,000 combined Social Security, him and his wife. That's one type of taxation, by the way. Modified adjusted gross income is how Social Security is calculated. And it's in our calculator, so you don't have to actually do it yourself. But and 15,000 of net long-term capital gains. Now that's at a different tax system than the tax brackets that I just showed you. So these are the reasons why it's so complex. When you're getting money from different sources and like your retirement plans, the money going in is easy. It's taking it out that's complicated. So that is why you hear people like myself espousing the virtues of getting help and not trying to be a lone wolf anymore, or just working with a broker, because they might have helped you then, but it's not the complete help that you need now. It doesn't mean that they're bad. It just means that they're not complete if they're not. And then they had to take RMDs of 45,000 from their IRA. So we put all that income together. And he said to me, he goes, is there such thing as a 50% tax bracket? He says, when I spent that I took out that $1,000, I literally ended up having other taxes that got triggered, and I ended up losing half of that. It cost me just around $500. And I says, no, there's no such thing as a 50% tax bracket. But what he thought would intuitively happen was this 120, that he would take that out, like I said a moment ago. But what actually happens was that, but that was not it. This is the collateral damage, I call it. What happened was he was at a certain point where even that little bit of money moved over, added to that tax year, caused $850 of taxable Social Security that was not taxable before. And that amount came out to $102. Then, remember the capital gains, a whole different system. He's at a 15% bracket for that, and it brought in $1,850 that was not before. So $1,000 withdrawal triggered all of this, and it came to just 50 cents short of $500 on a $1,000 withdrawal. Let's prove it out. And this is one of my last slides here. Okay, I'm going to get rid of that first. So this is part of how we determine tax planning for a given year or a series of years or whatever. And you'll see two columns here in scenario one. And you see that their income gross is 120. That was that fact pattern. You got the Social Security, capital gains, RMDs, all that good stuff. Okay. But then the right side is what of that amount on the left translates over into the tax filter. Okay, so long-term capital gains is calculated internally. You can't see anything different with that right now with this system. But the IRA distributions, and then you see how much of their Social Security from the left was pulled into the taxable side, which was 45,000. 75% of their Social Security got pulled in. So the comparison point here is the linchpin is the bottom line. They paid 81.39 in federal taxes with those income items. But here's the proof that when they pulled that extra $1,000 out, how did it actually do that? You can't fake this stuff, folks. This is software that I didn't create. And it shows right here. You have to look at the very bottom, 81.39 versus 86.39. That's $500, folks, on a $1,000 withdrawal. You can see what it did up here with Social Security. It brought that up to 45,950, which was just like it said. Another $850 was put into the taxes just from an innocent 1,000. Now, if they had just a bank account or something that was already after tax money, they could have taken that out and it would have affected this formula at all. But they didn't know that, or they didn't think to know that, or they were too focused on enjoying their family in December that they didn't want us to figure it out. But we weren't their people at that time. But there you go. That is collateral damage, and I'll leave it with this one thing. Imagine if they pulled out $10,000. You talk about, so you cannot eyeball your taxes in retirement. So when you visit with us virtually or otherwise, I'm giving you an opportunity to contact us for either a virtual or a one-on-one visit, which we're doing both. We just want you to know that you don't have to bring anything with you, well, especially if it's virtual, but you don't have to bring anything with you if you do come in. We're just gonna have a conversation virtually or otherwise. It'll be, what's your situation? What are your questions? What are your concerns? If we think we can help you, we'll explain our entire process. And you'll know that if you want to come in and start to engage us in it, because we'll show you samples of a written retirement income plan and all the things that go into it and how we build that over a series of appointments for you. Also very much on risk tolerance, all the stuff I've been talking about here, but catered towards just you, and if you have a spouse as well. So we'll show you all of those things, and we'll also give you a sample of a tax reduction analysis to show you that. So we've put it all together here so that everybody can get the best information in as many different ways as possible. I'm going to just kind of give you a couple of words here as we wrap up, if I may. You know, one time a friend of mine went to, with his family, his two boys, his wife and two boys, to the Grand Canyon, you know, and along this one long day that they had, they were just going to their last stretch for the night, and they were going to stay over, and they saw that it was 48 miles to their site, but they were a little low on gas. The boys were asleep in the back, so they didn't want to disturb them, but the wife insisted on, let's get gas so we don't have to worry about it. The husband thought differently, of course, like many of us do. I could wing it. You know, he might even add a little excitement. He just was frustrated and tired too, and he just wanted to go. So they had different agendas, but they did go anyway. So as they go on, you know, we hit 15 miles, 10 miles, 6 miles or so. They're starting to look at the gas gauge because it is on empty. And now they really do not know. It's not a highly computerized car or anything at the time, and you know they don't know if they're really going to make it. So they're really just looking at that gas gauge at the last 6-7 miles of this whole thing. And you know what? The boys even woke up after a while and they started watching the gas gauge as well, because, well, what's mom and dad doing? What's going on? So it became the whole thing. And ironically, once they finally did make it there, without having to walk 3 miles for gas in 110-degree weather. But you know what? They realized that when they got there, the shopkeeper says, "Did you guys? So what was your favorite stuff? Well, what was the favorite thing that you guys saw out there? That, you know, because this is some of the most beautiful landscape, and just not the country, but in the world." And they kind of looked at each other and they said, You can see much of anything except that gas gauge. But why would I be telling you this? I'm telling you this because that is one of the many examples that you would never do on important life-changing type of things. You would never go ill-prepared. You know, you wouldn't fill up, if you're a pilot, you wouldn't fill up your plane, you know, or take it further than you could take it back with fuel that you have. You have to plan, right? You wouldn't even take a random road trip without figuring out, like, what are we going to eat? Where are we going to go? How long is this going to be? Why would we be any less prepared for our retirement? So I really would encourage you to go to alphaplanners.com, and there are very obvious spots up there where you can see that you could request a virtual appointment or a personal appointment. Either way, we would just contact you back and kind of see what you're comfortable with doing if you weren't clear. And we'll also send you, if you do go to the site and do set for a virtual or a physical face-to-face 6 feet apart appointment, you can, we will send you the Retirement 2020 book that I showed you at the beginning. It's a very easy, quick read, but it's got, like usual, I always say the industry's underserved people, so it has a lot of great information, no fluff. And a lot of it's going to be stuff that I've talked about here and other things that are a little deeper than I had time to go into here. So, so that's we'll get you that free book out, and our team would love to meet you one way or another. We do believe that, you know, relationships are the most important thing here, because the knowledge, we got that covered, but it's really most important is the relationship and the trust we can build with each other. So my team and I all look forward to seeing each and every one of you in some form or another. I'm going to take my face off here and share back the screen, and I'm just going to roll out. And just remember, our golden rule, Alpha Planning's golden rule, is that we do this every day, but our clients will only retire once, and it has to be treated each time as like your hair's on fire. That is so important that you have to listen to every word. You have to try to re-explain, if need be, anything that you think is critical to them, to their safety or for their security going forward. So thank you very much for listening. I appreciate it, and I invite you to watch this very, very brief video on our philosophy.
Primarily about
We will
sales
see you
first,
soon. Thank you.
true professional advice second. Independence is wonderful, and it's been the one thing, the reason I started 25 years ago, just because service to others automatically comes back and provides the stuff that you're in business for. You really want to just legitimately, genuinely try to help everybody, and then the relationship will take its course.
The reason I'm in this business, my dad was an advisor, and growing up, I got to attend certain client events with him and really see the satisfaction on people's faces. Starting at a firm in this industry where really the focus is sadly on pushing products and selling things that aren't the best fit for people was eye-opening to me in a very negative way. When Jeff brought me onto his team, it was a match made in heaven.
The best part of it is that we are a true team. We truly speak with each other. We put ideas off of each other. And when I was being interviewed, I walked into Alpha Planning and I met with Jeff. I felt at home from the minute I walked in those doors. That's what I want you as a client to feel.
Our goal is to make sure that you've gotten the best treatment you've ever gotten from anyone in our industry, number one. You've also never been rushed to a decision. Our clients and our team have the same goal. We all want them to have financial security throughout. And tell you what, mountains can be moved.